2025, the financial markets saw tremendous growth despite global tension and tariff wars. Major indices, including the S&P 500, reached new all-time highs during the year. Technology stocks led the charge, and names like Nvidia became symbols of easy wealth, fueled by the AI wave. The digital asset markets were not left behind. Bitcoin surged to a new all-time high of $126,000 in early October, pulling millions of new traders and investors into the market. To many people, it looked like the market had become predictable, like opportunity was obvious, like if you were smart enough, you couldn't lose. Then, October 10th arrived, and the market reminded everyone of something they had forgotten. In just a few moments, the mood changed completely. Markets that had been climbing for months suddenly turned red. Over $2 trillion was wiped out from the U.S. stock market, with over $19 billion wiped out from the crypto market, the single largest in history. And confidence disappeared faster than it arrived. Although stocks eventually found their footing again, crypto didn't. And that's where the real lesson begins. Because what happened next wasn't just about price, it was about belief. I remember someone who entered the market during that rally. Everything he touched seemed to go up. Every dip felt like an opportunity. Losses didn't worry him, because the market always came back. Then the crash happened. And for the first time, he didn't ask what to buy next. He asked something else. Why does this feel so different from what I expected? That question doesn't come from bad luck. It comes from a belief most people carry into the market. And today, we're going to talk about the biggest lie people believe about the market. If you have not subscribed yet, hit the subscription button now. And remember, this video is not financial advice. It is only for educational purposes. The number one lie people believe about the markets is the illusion that the market was designed to reward them at all times. Many people think that once they understand the charts, study indicators, follow economic news, and stay informed about what is happening globally, then the market should naturally reward them in a short period of time. They hope to build a six-figure portfolio in the shortest possible time. Well, it sounds reasonable, right? It is true that learning and understanding the market is very important if you want to make money from it. But it is also important to remember that the market does not operate on intelligence alone, and it does not reward effort in the way most people expect. The market operates on probability, risk, timing, and behavior, not on how confident or informed someone feels. For example, you might believe the market will hit a certain threshold because the charts are bullish, influencers are projecting massive rallies on social media, and adoption appears to be accelerating. Everything looks aligned. Then a single news hit, a tariff war headline, or a policy decision. And within minutes, prices move violently in the opposite direction. Using the crypto market as an example, a clear case scenario is the October 10th market crash. On October 6th, Bitcoin hit a new all-time high of $126,000, and many analysts and experts were projecting a move toward $30,000. But just 4 days later, a single news triggered a massive sell-off, pushing the price below $10,000 in a very short period of time. At that moment, intelligence offered no protection. Charts did not pause, indicators did not explain themselves, and the market did not care how logical the analysis seemed. Billions were wiped out from the market. Some people lost all their portfolios that took weeks or months to build. So, what does this teach you? It means the market is not designed to reward you at all time or follow your expectations. The market reacts to new information, changing conditions, and collective behavior, not individual confidence. And when beginners believe the market is supposed to reward them quickly for being smart, they are unprepared for moments like this. Another negative belief is the illusion that short-term wins mean you have figured the market out. After a few successful trades, many people start to believe that their approach works consistently, that their understanding is complete, and that they have somehow cracked the market's code. This belief often forms very early, especially when someone enters the market during a favorable period. But they forget that when the market is on a bullish rally, even poor decisions can look like good ones. A few winning trades then begin to feel like proof of skill, when in reality, They may simply be the result of favorable market conditions. For instance, in this era of AI, many AI stocks have witnessed massive rallies over the past months, driven by the AI boom. In 2025 alone, Nvidia gained over 38% in value, hitting a market cap of over $5 trillion at one point. Outside that, other tech stocks also witnessed massive growth in the past months, showing that when the market is in a favorable condition, it can reward almost any strategy, regardless of how the setup looks. And when this happens, people start confusing good market conditions with good decision-making. At that point, people begin trusting their judgment more than their rules. They start believing their entries are better than they really are, and that their understanding of the market is deeper than it actually is. This belief is further reinforced by social media hype, where people post screenshots of winning trades, celebrate gains, and claim to be experts in technical analysis, candlestick reading, and researching the best stock to buy. But the real truth is simple. The success is coming from the favorable market conditions, not real skill. When the market is trending strongly, mistakes are easily hidden. Bad entries still work. Poor risk control goes unpunished. And this creates a false sense of confidence. But when the conditions change, that same behavior starts to produce losses. Positions that once looked safe suddenly become risky. Trades that once worked begin to fail. Stocks that were projected to hit double-digit gains begin to decline. And this is how people spend months slowly building a portfolio, only to lose it within minutes. At that point, the problem is no longer the market. The problem becomes behavior. And once behavior changes, risk naturally increases. And when risk increases without proper control, the market no longer needs a major event to cause damage. Small mistakes begin to add up. Emotions start to take over, and consistency breaks down. This is how people slowly move into the next dangerous belief. I need to be active to make money. At this point, people think they need to be active 24 hours a day to make money. Their mind tells them they are losing because of inactivity. You begin to hear things like, I wish I had bought this stock 2 months ago. I wish I had bought this coin last week. In essence, their mind is now programmed to believe that if they are not trading, they are missing opportunities, and that sitting on the sidelines means falling behind others who are constantly in positions. This belief usually forms right after the first meaningful loss. When someone has been winning consistently and then loses a trade for the first time, the loss feels confusing. Not because it was large, but because it wasn't expected. At this point, people begin overtrading, taking positions simply because the price is moving. They chase moves after a breakout has already happened, afraid that the market will run without them. They enter trades without clear setups, convincing themselves that being involved is better than waiting. The market consistently punishes this behavior. Every trade carries risk, and the more trades you take, the more exposed you become to mistakes. Slippage increases, fees add up, emotions build, and decision quality drops. More trades do not mean better trades, especially when they are driven by urgency instead of structure. You see this clearly during high volatility periods. Price moves quickly, candles become larger, and emotions rise. Traders who are too eager to recover from losses often enter at the worst moments, buying near highs or selling near lows, not because the setup is valid, but because they fear missing out. At this point, they start to increase their position sizes. They start putting more money into the market, believing that a bigger position will bring faster results. Because they have experienced profits before losses, their mindset becomes shaped by the idea that recovery is always possible and that one good trade can produce big gains. This is where behavior shifts from patience to urgency. Instead of slowing down, they press harder. Instead of protecting capital, they chase recovery. And this brings us to the next belief. Bigger positions fix smaller profits. Once traders believe they must always be active, the next logical step is increasing size. When small gains feel slow and frequent trades do not deliver the results expected, many traders start believing that the problem is not the strategy, but the size of the position. They begin telling themselves that one good trade can fix everything. That increasing size will speed up progress. That if they are confident enough, the market will reward them faster. But what they fail to remember is that bigger positions do not fix weak discipline. They amplify it. When position sizes grow without proper control, losses grow faster than confidence. A small mistake becomes a large drawdown. Emotions become harder to manage. Fear and urgency take over decision-making. And instead of slowing down, traders often press harder, trying to recover what was lost. At this point, the market no longer needs a major event to cause damage. Normal price movement is enough. Small pullbacks feel unbearable. Ordinary losses feel personal, and consistency completely breaks down. This is how many traders blow accounts, not because their ideas were wrong, but because their risk was out of control. And once this happens, the market begins to feel unfair, random, and unpredictable, which leads to the final belief: the market is gambling. After everything that has happened, overtrading, increasing position sizes, chasing moves, and watching losses pile up, many beginners arrive at their final belief: that the market is gambling. At this stage, trading no longer feels logical. Setups stop working. Entries feel random, wins feel lucky, and losses feel unfair. From the outside, it looks like the market has no rules, no structure, and no consistency. But this belief does not come from how the market actually works. It comes from what led up to this point. When someone believes the market should reward intelligence quickly, early wins create confidence without discipline. Now, that confidence leads to constant activity, and constant activity leads to larger risk-taking, and larger risk-taking turns normal market movement into emotional chaos. Once risk is out of control, outcomes begin to feel random. A small move feels catastrophic. A normal loss feels like punishment. And because decisions are now driven by emotion instead of process, results appear unpredictable. This is where people say things like, "The market is manipulated," or "It's all luck," or "Trading is no different from gambling." But the truth is simple. The market did not become gambling. The approach you used did. The market has always been based on probability, risk, and discipline. But when structure is removed, when rules are ignored, and when behavior becomes reactive, even a structured system begins to feel like chance. This is why two people can trade the same market under the same conditions and have completely different results. One makes money and the other loses his life savings. The difference is not intelligence, it is belief and behavior. Once the correct beliefs are in place, patience over urgency, risk over reward, process over excitement, the market stops feeling random. It starts to feel difficult, but fair. And that is the point where consistency becomes possible. Remember, the ultimate goal of a smart trader is to protect their capital. Without it, you cannot trade, you cannot recover, and you cannot stay in the market long enough to be consistent. And once that perspective is lost, every decision that follows becomes harder. When you look back at everything we've covered, one thing becomes clear. Most people don't fail in the market because the market is unfair. They fail because the beliefs they bring into the market quietly work against them. They believe the market should reward them quickly if they are smart. They believe early wins mean they have figured it out. They believe constant activity is the same as progress. They believe bigger positions can fix slow results. And eventually, they believe the market is gambling. But none of these beliefs describes how the market actually works. The market does not reward speed. It does not reward overconfidence, and it does not reward effort. It rewards patience, discipline, and risk control over time. Once you understand this, everything changes. You stop forcing trades, you stop chasing movement, you stop trying to recover losses quickly, and you stop blaming the market for outcomes created by your own behavior. The goal is no longer to win fast. The goal is to survive long enough to become consistent. Once you begin to master these principles, the market starts to feel less emotional and more structured. Decisions become clearer, risk becomes controlled, and progress becomes steady instead of chaotic. Remember, this is not financial advice. This content is for educational purposes only. Investing and trading are risky and can wipe out your portfolio if you don't know what you are doing. Do not invest what you cannot afford to lose. If you found this video helpful, please like, share, and subscribe. Thank you.